Hello, welcome to this class number 13. In this session, we shall discuss about how the profit and loss and balance sheet would be developed in the second period of operation of a business entity. And we shall also assume in the same manner that this second period is consisting of 3 months period. If we can get the meaning, or if we can understand how this is built up in 3 months, we can extend it for 1 year also. Now, let us start. Now, always remember, when we start for a new period, the profit and loss will start afresh. Why profit and loss will start afresh? Because in the last session, that is session 12, we have seen whatever the surplus or deficit of profit and loss is transferred to the balance sheet. So profit and loss was closed in the previous financial year. However, balance sheet will start from the last year's closing balance would be the opening balance. So that means balance sheet continues. So what is the balance sheet? Balance sheet means the inflow and outflow on account of asset and liability since the inception of the business entity. So in this case, if you look at it, the balance sheet, we are starting it, all the closing balance of the last year or last period would be captured here. Whereas the profit and loss starts its afresh. Now, during this period, we will discuss about activities which have been carried out by the business entity, same kind of activities. First, raw material of rupees 40 lakhs was used on September 30 till the September 13th, and then the entire raw material which is consumed would be converted into finished goods through WIP stage. During this period, an expenses of 6 lakhs would be incurred on account of salary and 4 lakhs on electricity expenses. Out of these expenses, 4 lakhs was paid on account of salary and 3 lakhs was paid on account of electricity expenses through bank. So it means that certain part of expenses has not been paid. Now, let us go one by one. First, 40 lakhs of raw material has been consumed. So this raw material has moved out of the store. So for that, the first entry would be the credit balance sheet asset current assets inventory raw material of 40 lakhs. Same logic what you have discussed in the past. Here, all the entries will follow the same logic. There is no different logic would be followed. Since in the asset side it is credit entry, so that's why it is coming as a negative, that's why red. So 40 positive minus 40, so the balance will become 0. Now, this is the first entry. Second entry for movement of raw material from store to the shop floor would be the debit profit and loss expenses consumptions of raw material. So this is the amount has been the captured. Now we shall capture the second transactions, that is this part. That means the expenses on account of salary and electricity expenses, and certain amount is paid and certain amount is not being paid. Now the amount which is not being paid, that is a deferred outflow. So in that case, credit balance sheet, current liability creditor for expenses of 2 lakhs and 1 lakhs on account of salary and electricity expenses would be captured. Look at it. Previously it was 6 lakhs. So this is 3 lakhs. So credit balance sheet creditor. So another 3 lakhs will come. Since balance sheet liability side, it is credit balance. So this 2 would be summing it up. Now the closing would be the, in that case, now it would be the 9. Now from the bank, 7 lakh would be the paid. So here, credit balance sheet asset bank. So asset side credit, that's why it is coming as a negative. So the closing balance would be 2. Now, the second entry of this transaction would be debit P&L expenses salary 6 lakhs and debit P&L electricity of 4 lakhs. That's what we have discussed in the previous lecture sessions. Now during this period, the WIP of previous period would be fully converted into finished goods. So WIP will move out. When the WIP is moving out, the first entry would be the credit balance sheet asset current assets WIP. So this would be debit balance sheet asset current assets inventory. So this will be WIP will move out. Since in the balance sheet asset side it is credit, that's minus. Now WIP will become 0. Now the second entry would be the, for accounting entry, the debit P&L expenses decrease in WIP. Now here, since we are capturing both increase or decrease, that's why I have put it increase stroke decrease of WIP. So increase here, if it is a decrease, then positive. If it is an increase, that is negative. So in this case, so debit 12, so that's a positive one. So debit 12, it has come. Now, next part is that during this period, the finished goods would be fully converted into sales. So what was the finished goods? 9, same logic, 9 will move out. Since 9 is moving out, no finished goods. Second entry would be the debit P&L expenses decrease in finished goods. So here it will come debit increase or decrease. Here it is decrease of finished goods of the 9. Now, during this period, whatever the WIP of 12, which is moved to the finished goods, and these finished goods would be converted during this period. Previous year's WIP would be converted into finished goods valued at 13. So first one is the movement of WIP from inventory. Now it is converting into finished goods, value is 13. So what would be the first entry? First entry would be the debit balance sheet asset current assets finished goods 13. So this one would be the debit balance sheet asset current assets, then inventory, it is 13. Now what would be the second entry? Second entry is the increase in finished goods. So increase in finished goods means here it will come as the negative part. So second entry would be the credit balance sheet P&L expenses increase in finished goods 13, which will come as a negative. So 9 was the debit and 13 was the negative credit. So the next balance would be 4. So that means during this period, the decrease in finished goods or increase in finished goods, here increase in finished goods to the tune of 4 will come up to this. Now what we'll do, now the entire finished goods of previous period, that is rupees 9 lakhs, which is moved out, now would be sold at 13 lakhs with an average credit period of 30 days. Now, so during this period, 30 days means the entire receivable would be realized. So first entry would be at the time of credit sales, this is deferred sales. So debit balance sheet asset, current assets, receivable of rupees 13 lakhs. So that is debit balance sheet asset. Now receivable previously was 25 lakhs. Now another 13 lakhs would be added. So 25 plus 13, 38 would be the closing balance of receivable up to this stage. Now you can find out that each head, whatever the new transaction is coming, it is either added or subtracted depending on debit or credit on the asset and liability side. So what would be the second entry? The second entry would be credit P&L income sales. So that is credit P&L income sales of 13. Here we are bringing the same concept, whether it's a cash sales or credit sales, both will come as an income. Now at the time of realization, so this is at the time of credit sales. Now when the realization is happening, so cash flow is happening immediate. So first entry will be the debit balance sheet current assets bank 13. So debit balance sheet current assets bank 13. So on asset side debit, so it will be added. Now 13 plus 2, it has become 15. So what would be the second entry? Second entry is means receivable is being realized. So second entry will be credit balance sheet asset current assets receivable 13. So here receivable was 38. Now it would be 13. So 13 is credit, it was debit. So minus, so now receivable would be 25. Now it is also being mentioned the entire receivable of previous period of 25 lakhs would be realized during this period. Again the same kind of entry, it will come like this. So first entry would be the debit balance sheet asset current assets bank 25. So here debit balance sheet asset current assets bank 25. Since it's debit, this plus this would be added. So it becomes 40. Now the second entry would be the credit balance sheet asset receivable 25 lakhs. So credit, so receivable would be 25 lakhs. Now it would be credit means minus. So receivable has become 0. Now the entire finished goods out of WIP of previous period, that is 13 lakhs, would be sold during this period of 15 lakhs on immediate payment basis. So what has happened previously, if you can recollect, previous period of 12 lakhs has been converted into finished goods at 13 lakhs. Now this 13 lakhs would be sold. So when it is getting sold, first finished goods will move out and then credit sales will take place. So let us look at it. So first one is the credit balance sheet asset finished goods would be 13 lakhs. So these finished goods would be moving out. So Since it's a credit balance, so negative will come, so it becomes 0. So debit would be the P&L expenses decrease in finished goods of 13. So here it would be decrease in finished goods would be 13. So we have the increase in finished goods of 4. That's a negative. So this 13 would be there. So closing balance would be 9 positive. So closing balance would be the 9 positive. So you can see that as the finished goods of WIP moved in or out of the store, the P&L gets changed from increase. Once it moves to the store, in that case, it is increasing. So that means it's becoming debit. Now, once moved to debit on the asset side, and what is happening? And in that case, credit on the P&L side. So P&L cost will come down. So when it is used, then P&L cost will go up, and from the inventory, it will come down. So if we can relate this, then absolutely no problem on this. Now the entire finished goods now, after moving out, we have captured the moving out part. Now it will be sold at 15 lakhs on immediate basis. So that means immediate means debit balance sheet asset current assets bank 15 lakhs. So here same 15 is coming, so it becomes 55. So what would be the second entry? It is coming from sales. So it would be credit P&L income sales of 15 lakhs. Now it will become 28. Now what is happening? Sales side, what we have discussed, both credit and cash sales both are coming. Now, whatever the opening balance of raw material which would be consumed would be converted into WIP finished goods and sales. So whatever the opening 40 lakhs was there, which is consumed, would be converted into WIP finished goods and sales. The valuation of WIP in finished goods is arrived at 8 lakhs and 12 lakhs. The remaining amount of raw material would be converted into finished goods and then sold at 34 lakhs on 90 days credit basis. Here what I am doing, this year's 40 lakhs, which was the closing balance of raw material of previous year, which has moved out of the store, for which we have passed an entry where raw material has become 0 and consumption as 40 has come. The entire will not be sold. Something would be on WIP, something would be finished goods, and something would be sold. So WIP would be valued by applying costing and finished goods as valued. So 8 and 12 would be the valuation of the WIP. So this means by this amount, your inventory will increase. So if the inventory is increasing, so definitely first entry would be the debit balance sheet asset current assets inventory of WIP of 8 lakhs. So here WIP of 8 lakhs will appear here. So that's why it is appeared. Now the second entry would be credit P&L expenses increase in WIP. Since it's an increase in WIP, it's a credit. So by that amount, this would be, the cost would be going down by 8. So the closing balance would be 4 in this stage. Let us look at it. Credit balance sheet expenses increase in WIP is 8 lakhs. Since it's a credit on the expenses side, it becomes now 4. Similarly, for finished goods, we see the same entry. So here 12 will come. Now these 12 will become credit. So 9 minus 12, 3 will come. So that is basically, if you look at it, minus 3 has come. Now, accounting entry for credit sales, that is 34 lakhs would be on credit sales. If it is a credit sales, so debit balance sheet asset receivable 34 lakhs. So here 34 lakhs would be added since there is no previous balance, 34 lakhs is added. Second entry would be the credit sales. So here the amount 28 and 34, 62 has happened. So here again credit sales is coming up. Now we'll see some other entries. Now first is that selling and distribution 4 lakhs and it is paid from bank. So if it is paid from bank, it is very easy. So here 4 would be debited. So that is the 4 negative. 4 negative will come. So 51. Now second entry would be here, that is debit P&L expenses, selling and distribution, that is 4. Now next, cash credit interest of 1 lakh would be charged. Since this is a cash credit, interest to 1 lakh would be charged. So when the interest is charged, accounting entry would be credit balance sheet liability cash credit 1 lakh. So credit balance sheet liability cash credit 1 lakh, because it's an outflow on the liability side. So second entry would be the debit P&L expenses. If you look at it, so cash credit is 30 previously 131. and P&L expenses interest is 1 lakh. So this is a P&L interest expense 1 lakh. So here interest is charged but not collected. Now when the interest will be collected, that means from bank account it will go. So what will happen? Bank account will go down by 1 lakh. So since bank account is coming 1, so it will become, here 51 was previous balance. Now 1 lakh is moving out. That's why it is credit. So 51 lakhs was the balance, 1 lakh is moving out. The balance should be 50 lakhs. Now, what would be the second entry? Second entry means it is going to the cash credit account. So debit balance sheet, current liability cash credit would be 1 lakh. So liability credit was 31 lakhs. Liability is becoming debit of 1 lakh. So closing balance would be 30. So closing balance is 30. Now, now what has happened? Some depreciation will take place. Now, if I see this during this period, same amount of depreciation would be there. Now, if the same amount of depreciation is there, so what will happen? In case of depreciation amount is for this period, the value of the plant and machinery would be 49 lakhs. No, it has to be, in this case, the value of the plant and machinery would be 48 lakhs. Why 48 lakhs? Because previously it was 49 lakhs. So value of the plant and machinery would be 48 lakhs. Now, to capture this, the following entry will be passed. It was 49 lakhs previously. Now, if it has to go down by another 1 lakhs, so what will happen? The accumulated depreciation of 1 lakhs would be passed. So credit balance sheet fixed assets, plant and machinery, accumulated depreciation of another 1 lakhs would be there. So the closing balance would be 2 lakhs. Now, the second entry, if you can recollect in the section 12, second entry would be P&L depreciation. This is for the year. So P&L depreciation in that case would be how much? So P&L depreciation would be the 1 lakh. So here what we have, this is 1 lakh. So it is coming here, debit P&L expenses depreciation. Now what we can say, EMI of 1 lakh is paid, out of which interest amount is 0.5 lakhs and principal amount of 0.42 lakhs. Same entry. First, from balance, bank balance will go down. So bank balance is going down by 1, 50 was there. So 1 will go out. So it becomes 49. Now for interest part, it would be in P&L. For principal part, it will come from term loan, just like previous case. So first the interest expenses 0.58, it's a debit expenses. So debit expense, it would be added. So 1.58, whereas the liability of 0.42 debit, liability 0.42 debit, liability will always be credit. Now if it is debit is coming by this amount, it will come down. So 0.42 will be deducted from here in the principal. So the balance should be 9.18. Same logic we used to follow. Now what we say that this entity will also purchase 40 lakhs of raw material for the next period, and this would be paid from bank. So first entry would be the immediate outflow. So from the bank, what will happen? 40 lakhs will move out. So this 40 lakhs is moving out. Since it's a credit balance, so it will become 40 would be there. 40 would be moving out from the balance. So credit negative. 49 was the before this activity, closing balance debit. Now 40 moves out. So credit of 40. So now the closing balance would be 9. Now what would be the second entry? Since it is going to the inventory, so raw material will go up by 40 lakhs. So second entry would be debit, balance sheet, asset, inventory, raw material 40 lakhs. So it would be the 40 lakhs. Now we'll see what would be the inventory, raw material, WIP and finished goods. That brings you 60. And the current assets is 103. Now what is the total asset? 103, 518 plus 48. That is, now assuming there is no other transaction. So this is the transactions for this period. Now what will happen? Now we have to see that what would be the profit. Now if we look at it, now the sales is 62. Now the difference amount would be the profit. So if you look at profit would be 4.42. Now how we have arrived at 42? First we find out sales, then all cost, and then the remaining amount is 4.42. This would be transferred where? This would be transferred to the retained earning. Previous retained earning was 3.40. Now retained earning has become 4.42. Again, this is credit. Previously it was credit. So credit plus credit would be the summation would be there. Since credit plus credit is the summation is there, in that case what will happen? Now your return earning will be 7.82. Now we have to see that whether balance sheet asset and liability is equal or not. Now on the asset side, if you look at it, now 48 is the fixed assets, 5 is the non-current assets 53, and 103 is the current assets, so 156. Liability side 107.82 and 9.18. 107 plus 9 is 116. 116 plus 107.82 plus 9.8 is 117. 117 plus 39. So this brings it to you of 156. Now you see both asset and liability is getting tallied, equal to tallied. So what you have learned for the second period, what is happening for the second period, from financial or from activity, how we are converting the accounting entries and P&L and balance sheet. With this, what you have learned at the beginning of the first year or first period of the inception, how you prepare P&L and balance sheet, and subsequent period, how you prepare the profit and loss and balance sheet. For the subsequent period, always remember the previous periods of WIP, finished goods, raw material will move out, and from raw material it will move out. When raw material is moving out, one entry. When it is going out to the going into the WIP, there is another entry. When it is moving out from the WIP, another entry. It is moving to the finished goods, another entry, and it will be moving out of the finished goods, another entry. Whenever it moves into the inventory, so what will happen? The first entry will be the debit balance sheet, asset, current assets, inventory, and for that entry, the expenses will go down. When it is moving out, then from the inventory, it will be credit entry, and P&L expenses would be added back, so or increase. So this is the things, if you can keep it in mind, there should not be any problem of capturing the profit and loss and balance sheet from financial accounting entry. I hope that you have been made clear. Now, what we will do 2 problems. I will give you 2 problems, and if you practice, then I am pretty sure that you will be understanding in a comprehensive manner that how accounting entry is being created from financial transactions and how the accounting entry would be converted into P&L and balance sheet. Now, up to now, you are very clear about from that how the P&L and balance sheet is prepared. And many congratulations to you, because what you have learned is a very important concepts of accounting, and you have got your fundamental clears. Now what we'll do, we will now, once we prepare the profit and loss and balance sheet, now the next sessions we shall talk about that what is the meaning of these items. And this I have made with an examples. In the next session, you will see actual, how we can see in actual P&L and balance sheet, and what are the implications of notes and what are the meaning of it. Thank you so much for watching this video. Thank you so much.